Well, good morning, folks. It is Wednesday, January 16th, 2019, and we are looking at the euro dollar. Okay, I just want to go over some drills with you, and I'm going to show you what I'm observing so you guys can see it. Alright, so we have a layer of liquidity that has been taken. This is sell side liquidity. So we have had a run on all the orders resting below these equal lows, and also below here. Right here. Alright, so now we have buy side liquidity untapped here. Right in there. Okay, so what we would be watching is to see if the breaker that is here, because we had equal highs here, so we had actually I have to change that now, don't I? So we have buy side liquidity here, and we had buy side liquidity here. Right there. So what you want to do is, when you're looking at your price action and studying it, whether it be live, preferably, but not necessary if you're learning, you have two areas in here that you're gauging where the institutional order flow is likely to reach for next. Now, we had Draghi speak this week so far. We had the Brexit vote now behind us. So we're in a consolidation. From a daily profile, we've had a London high of day form. Okay, and I know some of you are going to ask, why is this not on 0500, Michael? I do not account for daylight savings time for my own personal analysis. I include it for completeness sake. That way, if you elect to observe it in your analysis, you can do that. I'm just sharing with you that the reason why it's at 400 is I do not, in my own personal analysis, I don't really shift it around based on daylight savings time, because there's a lot of countries in the world that actually don't observe daylight savings time. All right, so we have the buy side liquidity ran here. We have the sell side liquidity ran here, and we're back at the breaker. Okay, the downside close here. This is our bearish breaker right in here. All the stops here were rated on this market protraction or Judas swing. So once price starts to break down, it does so here, reaches below this point of liquidity to reach for the sell side liquidity here. So we see that. Now we're trading right back up into it. What we're looking for is, we want to see if the market has enough energy, or classically referred to as momentum, if you want to call it that, to get above the mean threshold of this breaker. Okay, so if price trades back through this, I'll be looking for this candle right here, which we've already seen this down close candle. We rallied away from it, so now this is a bullish order block. Price trades down into it right here, they capitalize it. New orders have been picked up, price starts to move away. If we trade through this candle here, this becomes a propulsion candle. So when this propulsion candle is validated, it means if we trade through here, we gotta get through the mean threshold. Once that occurs, and if it does, and we don't know if it is, we will be able to anticipate a greater run to liquidity on the outside. And we would be targeting this bearish order block right here. And I'll outline that here. Right there. So you have a deeper pocket of liquidity above this initial run. Okay, and we'll use that as our boundary for intraday. Given the current context of what's being shown, it's more likely that it will roll lower because of the breaker. We've had liquidity ran here. During London, the high of the day formed at 4 a.m. New York time. So it's basically it's the heart of the ICT London Open Kill Zone. So in here we have several things we can look at. Number one, we have the potential for a sell, which I elected side with more because we have the daily profile in play. We had a really nice run lower, came back up, rebalanced to the breaker again. And also, if we look at the middle point of that breaker, right here, equilibrium is here. Essentially, that's what we traded to. It respected the mean threshold and lower. Okay, so we have this breaker we traded to. Also, London high of the day. Now we're at another breaker here, right at the base of that breaker. So what we'll do is we'll go in and we will trade 3, and we'll use a stop of 1405. And we'll look for a run to 1370. And we will sell it. See if we can touch this this low again. I may not be able to get that because I'm explaining it as I'm doing it. It's one of the shortcomings that come along with being an educator, trying to explain things as it happens on the fly. Okay, so we are trading inside of the breaker now, right here. And we will go actually do not like that. I'm going to wait and see what it does here. It's one of those live experience factors kicking in. I was expecting this to actually create a new opening down here and punch up to this low on a wicking basis, try to catch that as an entry short, and then reach lower. That's what I was trying to do. I'm waiting to see what it does here. I want to see it trade down on this candle and then come back up and retouch this inside the same candle we're looking at being formed here. So it's a 15-minute candle, so we have plenty of time. It just started. It's only been birthed 2 minutes ago. It's 9:02 a.m. New York time. Come back to that. So if we have a run on liquidity that is deeper, we'll look for a 10 to 30 pip sweep respective to this low, and that would put us here. So we're framing out our day. The likelihood of just reading price action, we're not using indicators. The only thing I pulled up was a fib just to get a clear description and delineation of a mean threshold of the breaker here, which we saw classically retraded to here, and I'm allowing for this. That's the reason why I held off doing the short initially, because I'm expecting this to maybe want to reach up to the mean threshold here. That's actually a better position entry, and then what I'll have to do is allow for the stop to be above the bearish breaker here, be above the bearish order block right here prior to this down move. So I'm watching this trade to this level. If we get to it at all, I'll look to go short there, mean threshold of the bearish breaker, and look for the liquidity run to I like 1370 initially. I'll look to take something off there if I can get a position, and then we could expand down to 1350 if we get some energy behind the move. This doesn't look like a bottoming formation to me. It looks like it's just consolidating. It came back, took the liquidity for trailed stop losses on any shorts, and now we're just really just allowing for another attempt to sell into a rally. So what I'm using here, my only plan is to show you the utilization of open float. Okay, that is not flout. Okay, open float. And I'll actually put this on here so that way conceptually you'll follow what this is teaching. Okay, so this is the lesson that we're using today. All I'm doing is looking at the order flow. We had a nice move here yesterday, consolidated, Judas swing, market protraction up to the buy side liquidity, ran that, London open kill zone, traded down, reached for the sell side liquidity here and here with this run, back to the breaker, which is now bearish because it's the down close candle right before the stop run. Okay, so it's not supply demand, it's a specific characteristic that is behind the interbank delivery algorithm. That's what this down close candle is more or less suggesting. So if we have a run to this level here, I'll go short right at that level, use a stop loss above 114.13, so my stop will be 114.15, round it to a 5 level, and my entry will be essentially 114 big figure. It'll probably be 114.01, 114.02, or thereabouts. It may spike up even more than that, and that may change my decision. I want to see how it trades to this. Okay, this is the part that experience is the teaching factor, not just watching a video or understanding what a book teaches. You have to know what you're looking for, and the only way you know what you're looking for is chart time. And while some of my concepts are very simplistic in terms of what they look like visually, like optimal trade entry and order blocks, every down close candle is not a bullish order block. No, now every up close candle you've learned is not a bearish order block. But conceptually, the idea is easy to see in the chart, especially in hindsight. Going forward, the insights that are gleaned from real-time chart study or hindsight reflective study, like if you're at work and you come home in the evening or in the morning, depending upon how you work, you look at charts that have already posted. In other words, everything hindsight. I developed my eye with that initially. So don't be discouraged if you can't do these things live because of work, or you're running a business, or you're doing whatever you're doing. You may be just unaware of the importance of looking at the data with the right mindset. You don't need to be poring over the charts hours upon hours, because actually that's going to be counterproductive to the overall goal of what you're trying to do. You want to teach yourself to see these reoccurring patterns. And if you don't limit the time, because you can look at something and pine over the idea of it being one thing, but if you stare at it long enough, give it enough time, you'll talk yourself right out of that. So you want to be able to train your eye and activate your reticular activator system with and activate your reticular activating system, which allows you to see the things that you have been studying over and over again. When it happens live, your mind will say, okay, this is that thing I understand and I look for. And then you, based on what you are expected to do by protocol, which is your trading plan, what do you do when these things form? Well, you engage. How do you engage? Well, I'm framing this out live. I literally turned the chart on after going through emails, and we're getting that run to that mean threshold of that. There it is right there. All right, so we will do the short 14. Oops, a little too much, Michael. We'll sell it right there. Alright, so we will sell it there. There's our framework. Mean threshold. Missed it because I had to adjust the order. And here's our stop loss, which is above the bearish order block in here. So if it stops us, it's not a big deal. It's $45. And you guys can see everything here. So everything is being shown to you. I gave you an accountability statement by tweeting the new account that I'm utilizing. You can see that account number is matching here. Here's the beginning balance. No other trades have been made with this account. As you can see, there's no account history to show apart from the starting of the demo account, the date I tweeted. Okay, so we will do this with the expectation that I'm going to try my best to try to do an execution every single day. Now, it's not my intent to be 100% accurate. In fact, it's not my intent to promote that idea, because you're not going to be 100% accurate. I'm not 100% accurate. I get lucky a lot, but you don't need to be highly accurate. But you need to be able to see when things go wrong, and I'll present some things that are intentionally meant to do as a mitigation of drawdown or losses. And here I'm framing the context as I shown here. There's no pencil whipping and torturing of the concepts to make it bend to my will. Okay, it is what I explained here, and we're just using the open float that's available because we've already ran the buy side liquidity here. We've already priced in a potential high of the day. It is Wednesday, so we could still see a continuation on the downside. Okay, so here's Monday, Tuesday, potential high of the week, down day, retrace back to logical area, mean threshold of the bearish breaker. Already ran buy side liquidity. Price broke down. It reached for sell side liquidity here and here. Came back to a point of rebalancing. Not in the sense that it's a void or anything like that. It's just going back to a bearish breaker. The mean threshold, we allow for that. We try to get in at or very close to it. Then we have to look back and see where's the next logical level, because price could still run to this bearish order block. But because of the overall price structure here, if it does trade to this bearish order block, I don't really want to be in this thing if it goes above it. In fact, I don't want to be in it if it goes to the middle of this up close candle here, right there. I don't want to be in the trade. I want to be stopped out and be moved to the sidelines, because it potentially could just run higher into this bearish order block, and it would reach for a higher run into this buy side liquidity, and it would just be a consolidation day, and they would have to just move to the sidelines at that point and try not to chase the impulse to, I want to get that money back for a loss. Okay, in other words, if I take a loss and it's $45 of a loss on a $5,000 account, it's so insignificant. My concern is disconnected from the equity. I'm not worried about being stopped out. So it frees my mind up to look at what is being shown in price action, and I can focus on the concepts conceptually being delivered in the candle formations. And really all we do is now watch and see if we get the delivery of price that we would reasonably expect. So what am I looking for? I want to see this candle. It can punch one more time up here. I'd rather see it not. But I want to see this open here, because we just opened up another 15-minute candle. It's 9:15 a.m. here. So I want to see this candle really just go lower and make an attempt to reach below here. Now, if we get the positive movement in favor of a down move, respecting the breaker here, if we trade below at this point, I will move the stop to 14.05. I'm not jamming it to break even. I'm not trying to get it into locking in profit, because it can do all kinds of chaotic price movements in here, because we still are essentially inside of a dealing range. If we manage the position from the standpoint of equilibrium, we have the high of the range here and the low of the range right there. So we're at equilibrium, essentially, very close to it with our entry. And if price breaks down to this low here, I don't want to be back in the trade. Well, not back in the trade. I don't want to be in the trade, rather, if it enters into the high end, the low end of the range. We don't want to get back in this portion up here. I'll change this. It's a little too busy. That's good. So if we trade if we trade lower and get down below this low, we do not want to be in any form of a retracement back up into this area here above equilibrium. In fact, we don't want to be back at equilibrium. We want to see price move away from equilibrium and seek the liquidity that's below this low here. Okay, so the theme of the day has been imbalance, rebalanced, buy side liquidity tapped, and then seek sell side delivery. It's still relatively early in the day for New York setups. We had a run to sell side liquidity here and here. This may be just a common retracement, if you will, and then more or less like the catapult effect, where it clicks back and then boom, it drops lower. If that occurs, like I said, if we get below this low here, the stop has to be managed from where it is at now at 114.15. It would drop down to 114.05. That would be above the equilibrium price point, and I would manage to see if at all, because it could still stop me out, but if it trades below this low here, I don't want to see it start going back up to equilibrium. So what I'm framing is premium to discount, and I'm using the open float, okay, and again, for definition purposes and for your notes, open float is the open interest above and below current dealing range. So the dealing range has been defined with this high and this low. That's the range we're inside of right now. All we did was trade back to equilibrium to that. So does this market, the euro, have the momentum to continue going lower to seek a deeper array of sell side liquidity, or does it chop sideways? If it chops sideways, not good. We want to see it move away and seek this liquidity here. If we do that, then we have the potential to, let's see what the entry was again. It would only be a 5 pip stop, which is only $15. So we're managing the risk initially. That's what we're looking for, to reduce the overall exposure to the market. Using this as an exercise, it's not designed to blow your equity up to towering heights of percentage returns. That's not what this is about. This is how you practice. You practice your entries, you practice your reading of price action, and you also put in chart time. This is what gives you the experience factor that's going to be needed even post mentorship core content. That means after you go through the 12 months content, these are the things you're going to draw on the most, because the concepts are what they are. But you can't attribute all the things that I just say in words or in my own examples and then transfer that, okay, into your own experience. You have to do these things on your own. Because it's not necessary to be profitable, to be learning, you do these exercises every single day. And you frame out where the liquidity is, where the daily direction is possibly reaching for, and then you just frame out all of the concepts conceptually, what may transpire, and then you engage. And you do it with this type of leverage. Okay, this is a $5,000 demo account. I'm not using a full standard lot. I'm just using 3 minis, and the risk is below 1%. So you're not worried about the money. You're teaching yourself execution, framework, rule-based thinking, and you're giving yourself experience. You're looking for the positive feedback of, is price doing what we would reasonably expect it to do? So I'm going to keep this box in here, okay, and remove the fib, only because it's already did its job by showing us what the equilibrium price point is, which is all we've done still. Even though we've traded just a little bit above it, that is permissible. Okay, we don't freak out. We don't care that it does this little wick up in here. We don't care about that. That's normal delivery. There's always going to be some errant price action that you have to factor in. Don't expect or demand the candles to be right at the specific price point you thought it was going to stop at, because it's going to drive you crazy. This to me is a reasonable amount of range. It shouldn't trade up to there if it's going to go lower. That's my thought process. So my stop is in a nice area. It's framed with conceptual ideas that support the fact that we've already ran the buy side liquidity, so therefore it shouldn't run back up here. And it's above the previous, at this point here, this would be a known area to sell short at. It's above the bearish breaker, so it's not likely to be traded to. So if it does trade to it, what does that indicate? The trade's probably wrong. So it gives us the insights that if we do, say I'm wrong, and it trades up into this candle, I can nix the trade, hopefully, before it hits the full stop. And that would be one of the protocols that would be used for your own trading plan. When do you kill a trade? Because there's a lot of things that talk about what gets people into a trade. What's the framework? What's my entry pattern? Where's my stop? Maybe they're fortunate enough to learn how to manage the position from a teacher or an educator. So most of the time they don't, but most educators, 99% of them, do not tell you how to kill the trade. Okay, they want you to think about getting in the trade, potentially profiting, so that way you're hooked and you buy into everything they'll say and you subscribe to their thought process as the guru. I'm teaching you how to be an independent thinker. When do you take the trade? When do you put the stop at a specific price point? When do you adjust the stop? And what kills the trade? While you're in a trade, if you don't see the factors that gave the trade idea to you initially still at play, then why let the stop be taken? You're spending, number one, you're spending mental capital that is far more expensive than the actual equity drawdown your trade would suffer if a full stop has been taken. As you can see, $45 on a $5,000 equity base is not a lot. It's not a lot at all. But if we can get to 113 mid figure, that's 50 pips. So the framework is ideal here. We're looking at better than 3 to 1, which is, in my opinion, the minimum that you should start looking for your frameworks in. All your trade ideas, there should be a minimum of that. Ideally 5 to 1, but this may not promote that scenario because we have a market environment based on the calendar. We're just mid-January. It's a soft start for us, and I'm just giving you the framework to go in and what you do every single day. Every single day you practice. If you can't do it live, you do it hypothetically in hindsight. You would mark out your chart. Now, granted, your eye's going to see what the actual price action did, so it's not as helpful or productive as it would be if you were doing it live, obviously. But I'm proof in the fact that I learned it from hindsight static charts. What had already traded on an hourly chart on the on bonds and S&P and the futures contract on currencies. That's how I taught myself to bridge the gap between what is occurring on the institutional side and what we can see in a price chart. We don't need to see the volume indicators that people look at, which is nothing more than a volume indicator that you would classically see along this axis. They put it over here, now it's suddenly something new. We don't need all those types of things. I haven't shown you anything in this chart except for horizontal trend line segments, just to highlight where a threshold would be above old highs, where buy stops would be. Now, I did not limit it to buy stops. Notice that I'm highlighting here is buy side liquidity, because that's open float. There could be buy stops here that would be protecting existing short positions, and or it would be buy stops for entries of new positions, or it could be just simply a transaction on a commerce basis. So when I say buy side liquidity, I don't want you just thinking, well, we're going to run buy stops. There's a greater depth to liquidity than just simply saying that. And the same thing is shown and expected for the sell side liquidity, just in reverse. There would be sell stops resting below those lows here for anyone that was trying to go long. sell stops to go in short as a new entry position, and or simply a commerce related basis for the market having an order there. It's not that someone's actively speculating that the euro dollar is going to go higher or lower. It's just from a commerce standpoint, there may be an entity out there that wants to execute, and it may be the bank that offers that transactional exchange to a corporate entity doing global commerce. So it's not a matter of, we're running sell stops and buy stops. We're running liquidity, and there's a pocket of liquidity that starts to pool and congregate around old lows and old highs, which is the basis for what we call a liquidity pool. The liquidity pool, the way I teach it, is framed on what we're showing here, open float. Now, you're going to hear terms like liquidity pool from educators like Chris Laurie, which he didn't create liquidity pools. It's just a term that is, by definition, the most generic concept or description of what it is. And I didn't create liquidity pools. It's a simple function of what the market does. And if you study his work, you'll see that when I say a liquidity pool, it's in stark contrast to what he would be indicating as a liquidity pool, because he teaches you how to go to a website, and I'm not going to tell you what that website is because I would be teaching his material, and I have respect for the guy, but he uses that as a tool to show where liquidity would be, and he'll show like bank reports saying that there should be orders here and there. I don't rely on that because I can see it conceptually and from a framework standpoint, and that's what open float is. Okay, what orders are existing and floating? This is why the concept is open float. It's floating out in the marketplace where it could be absorbed or tapped into. So right now there is liquidity forming above here, this candle that's forming. There's a little bit of liquidity that will be formed here. For anyone that's short, they would have their stop loss here trailed, and you're probably saying, well, why do I have my stop loss there? I've already explained it. Go back and listen to the video again. This bearish breaker is what I'm trading on. I'm also trading on the idea that this is potentially the high of the day, and we have ran the stops right below this low here, and I believe that this was too shallow of a move with existing daily range left. In other words, there's some battery left in the life cycle of this particular trading day, and I'm expecting to see the market to trade a little bit lower. Now, we've mapped out a 30 pip grade run below this low with this move here, with this shaded box. So I'm going to put horizontal lines in here just to give you a visual. Okay, so we have 1384, so we would need 1375. We're going to round to the 5 levels that we're calibrating now, remember. And then we'll have 65. If these things would stop moving. And then we'll have 55. All right, and now we can take this off. Everything's been calibrated, and we don't need this box anymore distracting us. So this is our levels with logical runs below this low, 10, 20, and 30 pip. So now we can just put our chart back in the normal perspective, and then if price rolls for us, the chart will update, and then these lines will come into view as they're necessary. I like to keep my wicks and such a little bit darker than what was being shown there. So what we're hoping to see is a swing high form. We have a nice little down close candle here. I want to see this next series of candles trade lower and aggressively move with expansion, large candles, reach below here, and reach below here. We have to be aware that it could hit 1375 and be done, and it could be done for the day, and that would be the low of the day. So if we can get to this price point at 75, we'd have to scale something off. And that would give us about 20 pips or so. And because it's an exercise, what I would like to do is, if I can get the movement to 1375, I would take one of the 3 minis off there, and in the next one I would try to take off at 1365, and then I would try to take one off at 1355, not holding for the rest. Now you're probably saying, well, you have your take profit below that. Why is that? Because I want a best case scenario. If I'm short, I have a short position on, and I have the framework outline where my stop is defined. I'm not worried about being stopped out. I'm more or less studying to see if I get the confirmation of the downside continuation. I want to, by my plan, want to take one off at 1375 of the 3 minis that's down here in my position. I want to take another one off at 1365, and I would like to be able to take one off at 1355 should time of day permit me to do so. But what happens if the market just beelines immediately right down to a run below 1355, and I don't have an opportunity to take off a mini at 1375 or take off a mini off at 65 or 55, and it runs right to this level here? Then I have the full boat, okay, the whole pool on the position at a level that was even greater than what I anticipated for my trade. So what I've created is the best case scenario. That's the best case. I'm getting more than I thought I was going to get out of the trade. I've already done my job as the trader to put the stop loss in. I'm not concerned about that anymore. I'm managing what I'm hopefully going to see is a delivery on the downside, seeking to run below this low and this low because they're still relatively equal. So we could see a run to this level here, surprisingly, all in a sudden movement, boom, like we saw here. In one 15-minute candle, price moved from a high of 1442 to a low of 1400. That's 42 pips in one 15-minute candle. So we have to allow, or at least I try to do this, I allow for a best case scenario where if it does move in my favor, I may not have the luxury of getting out with a partial at where I logically have in place before the fact, before it trades down to these levels. If it does at all, we don't know that. But if it does, and it allows me to, that's what I want to scale out at. But what happens if it moves in your direction faster than you thought it would? To keep me from getting frozen like a deer in headlights, because it's happened to me a lot in my 26 years, if I have a trade that's panning out profitably, or it starts moving in my favor, I forget my trading plan. Like, what am I supposed to do? I mean, do I hold it? Do I add more? Do I trade my stop? I've removed all that by giving myself the best case scenario. And you don't see that in books. You don't see any educators talking about that because I think they're limited in their exposure and their experience in trading. I don't think really 99% of them are actually profitable. So they haven't had the experiences of what I'm explaining here, where if you're right a lot, you tend to see moves really start to pan out in your favor with this type of movement and energy behind it. So wouldn't it make sense to have something in place like we have our stop loss? Okay, if price jams up here and stops me out, who cares? I don't care. I'm not worried about showing you losses. I'm not worried about that. I need to be able to show you losses because you're going to encounter them. So that way you have a plan on how to mitigate them and just trade through them, because it's going to be a normal function of your trading career. You're going to give and take from your account. You're going to do things right. You're going to do things wrong. I'm going to do things right. I'm going to do things wrong. We're all human. You're going to mess it up. But you need to make those mess ups to such a degree that it does not do you harm. It doesn't negatively impact your ability to follow the plan still. It doesn't sway your opinion about the concepts. It doesn't deafen your ear to when I'm giving you insights, because it's one thing to listen to something and expect it to pan out because I said so, and then all of a sudden, well, the last time he said that, it didn't work out. If you think that way, you're actually fueling toxic thinking, and you're actually reinforcing a negative thought process around the whole concept of you learning what I'm teaching. And it's not that we're trying to be perfect. It's not that I am perfect. It's not that you're going to have a high accuracy rate. For a long time, you're not going to have that. That you grow into that. And you may not ever get to it, but you still don't need a high accuracy rate to do very well. You don't need that. So the exercises that we're talking about here, I'm giving you framework to allow that, just like we give a stop loss in all of our positions, we frame out a logical stop loss, what would be conceptually reasonable to see in terms of a price movement higher. I'm deep inside of the upper portion of the range. Again, the dealing range is this high and this low. Let me scrunch this back up so it's a little bit better. So the dealing range is this high and this low. So my stop isn't deep. It's above the midpoint of this range. Okay, so we have equilibrium here, which is halfway point of this low and this high. So my stop is in a premium level. And it's also above the bearish order block. So I really don't want to be in a trade if we trade back up to that bearish order block. I don't want that. I will allow the stop to be fully taken for this exercise. But just like we look for a catastrophic protective mechanism in the form of our stop loss, this is I don't want to be in a trade if it goes there, because if it goes there, it's probably going to go higher. And it's going to reach to here. And I don't want to sit in a trade that I'm short here and ride all the way up to there. I don't want that. You wouldn't want that either. But just like we use the concepts to frame out where our stop loss should be, doesn't it make sense to have something in place that if we are right, say we're lucky, okay, quote unquote lucky, and the market really moves in our favor, wouldn't it make sense to have something in place, just like we have a catastrophic mechanism, okay, in place to protect against catastrophic loss or unlimited loss or margin call, because that's what the stop loss is there. That's its job. Its function is to do that. No one really teaches how to incorporate the best case scenario for your trade. So many times I'll have my take profits well beyond what would be reasonably expected from my concepts. Like if I'm expecting it to be bullish and you're looking for it to trade up to an old high and 10 pips above that, sometimes it'll be 50 pips above it initially. And when you see charts, or if you see examples, if you go back and look at my videos I did when I was teaching for free on baby pips, you'll see many times I have take profits that are way outside of what would reasonably be expected as a daily range. Because why? I'm giving myself the potential to do exceedingly more than I framed out for the idea. So in my mind, it just makes good sense to do that, because we all know where we have to limit our loss. Our losses are going to be hopefully controlled by our sound placement of our stop loss orders. Once that's placed, like mine is here, that is done. We're not concerned about it anymore. Let it do its job. I'm not worried about it. It knows what it's supposed to do. If price trades to it, it stops me out. Fine. Let it stop me out. That's what I'm paying it to do. I'm paying $45 for that stop order to keep me from losing more money. I've already made that commitment. It's a trade. It is not what we want as a trader. We don't want to give away money. We don't want to lose equity. But you have to fund your business. So the transactional cost of me paying $45 to keep me from losing more, that's what the stop loss order is going to do for me. I'm paying it $45 to keep me from losing more money. Well, you have to give yourself a chance to get a bonus. And that's what I have down here. My order is beyond where I would logically take out partials on a scaling basis. If I can get that order down here, guess what? I'm right. If it goes to that price point, I'm right, and I get that cookie, that feel-good moment. But I really get a bonus because not only does it hit all 3 of my targets, but it goes beyond that, and I already had the order in place. And it was automatically done for me, all by price action. It reaches for it, it takes the order, and I'm done. There's no greater feeling I've ever had in trading than seeing a move that happened in my direction, in my analysis, and go beyond where I thought it was going to go. And then I also got out of it. Many times in my examples over the years where you see me getting out at the highs or the lows or maybe 1 or 2 pips off, I'm using this very strategy here. I'm using the best case scenario. Now, I don't always get those fills, and it's not necessary for you to build that in your plan where I got to get this or I'm not doing well. Don't have that thought process. Don't think like that. Because if you're doing that, what you're doing is you're feeding this environment where it doesn't happen a lot for me. So I want you to know that it doesn't happen a lot, but the few times that it has, it's such a rewarding feeling because I've reached all my goals. I didn't have to partially exit anything. I have a full pull. That means the full position, I pull the trade based on it hitting a target that is outside of the range of what my concepts would give me. And to me, if you're going to be on autopilot, like if you're working, okay, if you're managing your own businesses, you can't be watching price. Have this strategy in your framework. So that way you might get that rollover in price that I'm outlining here as a potential. Now, I don't care if it doesn't do it. I'm not worried about that. I don't care if it goes up and hits a stop because that gives me another lesson to teach you how to work with mitigating a loss. Because I haven't shown any losses in such a long time. I'm showing you how every single day, engaging every single day, you're going to have losses. And what that will do is it desensitizes you to them. Like you're not worried about them because they're normal. They're like mosquito bites. Nobody really likes them, but you're not dying from them either unless you're getting malaria. And what would be an example of that? Having your stop loss up here. Or not having a stop loss, okay? And then bailing out of the trade because you just can't handle the pressure anymore. They're a nuisance. They are required, though. You need them. So as much as you don't like the pain of being stopped out, and you don't like that feeling of being wrong, you remove all of that by doing drills every single day, engaging every single day. When I learned early on in the 90s, one of the lessons I learned by pain, I didn't listen when it was given to me by my original mentor, Larry Williams. He says, and he had an analogy, and I've said this many times in my free tutorials as well, but I'm crediting him because that's where I heard it from. Let's say you walk out your house and you walk down the street and you come in front of a house, a blue house with a white picket fence, and you walk by this fence, and all of a sudden this dog, this Rottweiler, okay, foaming at the mouth, comes running, charging at the fence, reaches over with its jaws and grabs a hold of your arm and shreds your shirt and your coat and whatever, and maybe gives you a little bit of a flesh wound with its fangs. You've experienced something. Now you have experience, okay? Do you need to go down that same road, walk in front of that blue house with that white picket fence 30, 40, 50 times to know that that's probably going to be the outcome if you're not careful? No, you don't. Of course not. So if we do daily exercises and drills of engaging price action with our expectation that certain phenomena should repeat over and over and over again, if the market is showing an unwillingness to share that continuity that you would reasonably expect with the concepts I teach, then you're gaining experience. And the experience does not have to be positive in the sense that you're rewarded monetarily, either by demo or in real money. You're learning, just like that experience of getting your arm almost torn off, okay? You now have a greater appreciation for the risks associated walking in front of a blue house with white picket fence on that particular set of on that particular street. Now, You may walk down that street again, but you're going to be thinking, this might happen. I may get bit. But then you start walking down there at different times of the day. Maybe it's late in the day or late in the evening. Maybe you have your own pet that you're walking down this same street. And you notice certain times of the day, this dog is not outside. So now what do? You have a framework. You can engage the risk, like the market. You can engage that risk. You're always aware that it's potentially there, but you're now managing it in such a way because you've experienced when it usually will hurt you and when it won't usually hurt you. Now, you don't know for certain just because you walk down in front of this certain blue house with a white picket fence that Cujo dog, okay, is going to be on the prowl. You don't know that. Just like you don't know if the trades you're taking are going to pan out. You don't know that. But you're always mindful and you're respectful of the likelihood that the market can hurt you. That's the reason why we use stop loss orders. That's the reason why we don't over leverage like you see here. That's only 3 minis. On Instagram, someone with this account size would probably have, a full standard lot or as much as they could possibly get on the position. I don't teach you that. I'm not trying to teach you to have a swelled head about how much money you can show in either in a demo account or how much money you can earn. I'm trying to teach you how to engage price action, how to work with a context that is repeating over and over and over again and still has the occasional hiccup where it doesn't pan out. You're going to be wrong. The market profile won't be constructive as much as you may think it will be in the beginning. In the beginning, really, you're not going to know what you're doing. And that's why you're doing drills and exercises. Every single day, you're looking at what the context of the marketplace is. Okay, we've made a potential high of the week at Tuesday. We ran the high on the London session today. We swept the low here, and we basically swept the low over here. But it was shallow, and we have a little bit of retracement. This may just simply be the New York retracement. It may be a little bit deeper, more pronounced, but it's going back to the middle of the breaker here. Now, admittedly, I don't like the fact that we're spending this much time above the mean threshold of that breaker. But I've already committed to a full stop on this. I'm allowing it to take the full stop because, number one, it's not that much in terms of damage. It also will create an opportunity for me to show you how it's not important for me to be right all the time. It's in fact better for me to show you what you're going to encounter when you do this on your own, which is get it wrong. You're going to have all the reasons like I've mapped out here that would suggest the likelihood of it doing what I've allowed in terms of my analysis, communicating what I think is a likely scenario for today. It may not do it, and that's okay. It doesn't ruin your trading career. It doesn't remove the likelihood of you being consistently accurate or building a consistent model. It is one more stepping stone for you moving towards your direction of being an independent thinker, consistently profitable on your own, decisions being made by you, trades being made by you, managed by you, knowing why you're doing it, having yourself the best potential to get the results and beyond the results that you would reasonably expect, and how to mitigate the downside, because there always is going to be a downside. There's risk. You're going to lose money in your demo, and if you ever trade with live funds, you will lose real money. So doesn't it make sense to prepare yourself for those losses and build a plan to keep those losses manageable, small, where they're just insignificant? It doesn't make any difference to you if you get that stop out or if it trades into your profit. You don't care. That's what you do this every single day for. You drill it in your head that all you're doing is watching price action. In fact, I'm not convinced that I probably should have used 3 minis here, even if it does trade like I want it to do. Maybe I should have just used 1 mini, because when you're practicing, I don't think you should be practicing taking partials when you're just studying price action. Try to get just positive movement Move your stop loss. Practice that first. Because the profit taking, that's the easy stuff. Managing your risk is the hard part, because everyone stops trading because they lost their money. That's the 100% rule. All traders stop trading because they lost their money. No one has said, I've made a lot of money, I'm just going to stop trading now. It doesn't work like that. Okay. So the number one lesson you want to learn is how to control the amount of losses that you take, so that way the damage is minuscule. So I'm going to leave this chart going. I'll leave the recording going, and we'll see what happens. Again, I'm going to let it run to the full stop if it will do it, but I'm going to see if it can make an attempt to get below this swing low here. And if it does either one, then that's when I'll come back and continue the audio commentary. Okay, so we have our stop out. We went into the order block here. I said that if it went up to here, it would probably be not so good. And the stop loss did its job. Account history. Okay, we're going to click on this, drag it up to the chart, drop it. You can see everything is as the details show below. So we're inside of a consolidation day. The stop did its job. So now what we do is we take this information and we transfer it to our journal. And this is where the learning starts. We take all of the experiences that we've had here. We make additional notations if we want. I'm going to do that and then I'll continue the video. So I'll pause the recording, and then you'll see all the additional annotations as a result. And then we'll continue on with the lesson. Okay, so now we have more annotations on the chart. We are in the premium end of the dealing range. We traded into a bearish order block. The stop was hit during that move above the equilibrium of the dealing range. So we haven't seen anything in terms of offering resistance by this breaker. Again, this is a 15-minute time frame. So the run on this liquidity here of equal highs. After running into this breaker, which is this candle here, I'm going to watch and see if we can get one more stab into this level here. If we do that, I'll go short again with the same premise. This time the stop will be again 15 pips. And again, the drill is we're going to anticipate a run deeper on the sell side liquidity. Okay, so we're short here. Drop this down. Drop this down to 15 pips. Here we are, again, 45. So if this is stopped out again, the total drawdown is still less than 2%. Same premise in mind. Now we have our take profit at the lower end of the 30 pips here. So again, I want to give myself the best case scenario. And we'll reach for 50. Mid figure. Okay. And while this is doing what it needs to be doing, we're going to go over to the log. So today I have a study journal entry exercise and example, if you will. Today's Wednesday, January 16, 2019. The pair I did a drill on was the euro dollar. Exercise was open float using a sell day profile, trading in the New York session. My observations were Tuesday, and I'll put the observations in real quick, and I'll save you the time of me typing it out. Alright, so you can see the notations. These are my observations, personal notations I've made about the trade, what I was looking for, what I was expecting during the trade, and you can include things like all the commentary I gave in respect to what things I was willing to do, should we trade lower, and should we do an opportunity of moving the stop because we trade to a particular new level of liquidity. Those things you would also include here if you felt so inclined. The more details that you give that are short bullet point things like this, the better it is for your journal. You don't want it to be wordy. You don't want it to be like a novella. You don't want it to be very, very long, because you want to be able to go back to it and refer to it in quick fashion. These are all very simple bullet point ideas, and I also always include the trade duration as a reminder of submission to time. A lot of times when we look at examples of my trades or other people's trades or even your own trades, you lose sight of how long you actually had to submit to time during that entire endeavor. So from the time we get in the trade to the time we get out, when we look at other people's trades, when we look at our own trades and share them with other people, not that you should do that, but it's discounted immediately how much time was involved between the entry and the exit. And new traders are very often plagued by impatience, and a reminder of how much time usually transpires between the entry and the exit, either by stop out or by take profit. So it's just a good rule of thumb to include the trade durations. If it's days that you're in the trade, obviously you would just state that in that format. But since this was a intraday volatility drill, looking for a run on open float, this was the total duration of the trade from entry to stop out. And then I include a copy of the chart with all the details, all the order numbers, balance changes, the stop out, and then the additional reference points. Okay. Additionally, I have in here that the full stop was taken, and I will monitor the bearish order block for possible reentry from loss mitigation. So if we scroll back down here to the chart, I'm looking at this bearish order block. It's inside of the premium end of the range. So this high to low, I'll be watching to see if I can get a return back into that. And if it does, I'll try to do another short to mitigate the 15 pip loss. And that's the only intention I have with it. Obviously, if it fleshes out to a little bit more opportunity, then I'll manage it to the best of my ability. But I'll include that also. And this is what we have for now. And I hope you found this insightful. And until next time, wish you good luck and good trading.